Everyone is obsessed with where interest rates are headed, waiting for the golden days when properties appreciated faster than borrowing costs. But after 10 rate hikes that took us from near 0 to 5%, the steepest climb in a generation, the Bank of Canada has finally started cutting rates. And for the first time in years, we're hearing something that we haven't heard in a long time. Rates are in a good place. So what does that actually mean? Does it unlock the market again? Will prices start to rise, or is this just another false start? And that's what this video is about, breaking down where interest rates really stand, what could still throw off the market, and of course what it means for buyers and sellers and investors heading into 2026. And because while everyone's talking about the end of high rates, the truth is the next phase might even be trickier.
Look, I get it. The Toronto real estate market is confusing. Whether you're a new or experienced investor or just looking for a home to raise your family in, join us at Broadview Table Talks as we sit around the table with my friends to talk about the real estate and the ever-changing market in Toronto.
If you remember a few years ago, open houses looked like they were street festivals. Buyers were lining up with offers in hand, fighting over each other to have the opportunity to buy something, just anything. It was pure FOMO, fear of missing out. But now it's flipped. We're in FOGI, which is fear of getting in. Buyers are cautious, sellers are nostalgic, and affordability still is out of reach for many. But underneath that hesitation, something's changing. After 9 rate cuts since last summer, 275 basis points of relief, the Bank of Canada's key rate is now below the 30-year average for the first time in years. Historically speaking, rates are in a good place. So what's going to happen next in the real estate market? If borrowing costs are finally easing, you think buyers will already be back out there, but real estate doesn't move that fast. Monetary policy is like steering a cargo ship. It takes months for a rate cut to ripple through the economy. Historically speaking, rates are in a good place. So what's going to happen in the real estate market next? If borrowing costs are finally easing, you would think that buyers would already be back out there shopping around and bidding up the market. But real estate doesn't really move that fast. Monetary policy is like steering a cargo ship. It takes months for rate cuts to ripple through the economy. The first signs are a bit more buyer activity, a few quicker sales, and that might show up within a few months. But the real lift in prices and confidence, that's more of a 2026 story. And even then, not every market moves together. Some cities haven't seen any real price dips, while expensive markets like Toronto and Vancouver are still taking a beating. Buyers are cautious, sellers are stubborn, and affordability is still the elephant in the room. So even though rates are finally in a good place, the housing story still depends on a few wildcards, and 4 to be exact. First, it's population growth. Ottawa's new budget confirmed what many expected. Immigration targets are coming down. The previous plan called for roughly 500,000 new permanent residents by year 2025, and now we're in 2025, that's been scaled back to 395,000, 380,000 in 2026, and 365 in 2027. The government's also tightening the flow of temporary residents, international students, and foreign workers to bring the share of the population down to about 5%. That was up at 7% at one point. So for Toronto, that means slower growth in rental demand and household formation, which could cool the market in the short term. Second is trade policy. If Trump wins back the White House and follows on his threat to pull out of CUSMA, which that could really rattle the Canadian economy really fast. Exports, jobs, consumer confidence, it's all tied to that relationship. And even though if it's just talk, it's enough to keep investors and developers cautious. Third, inflation and mortgage rates. Core inflation is still north of 3%, and consumer expectations remain around 4%. Combine that with even higher raw material costs and elevated wage growth. It's clear we're not out of the inflation woods just yet. And the fourth wild card, well, the federal budget itself that just got released today. Ottawa just rolled up billions in new spending aimed at boosting growth, building housing, and supporting infrastructure. All that sounds great for the economy, but also risks keeping inflation sticky. The Bank of Canada, it could tie their hands and really slow down future rate cuts. So yes, rates are in a good place, but it's a fragile one. Immigration's cooling, trade's uncertain, inflation's stubborn, and the fiscal policy really could tilt the balance either way. Where does that leave us? Well, if rates simply hold steady from here, it's already a win for the housing market. Stability is the one thing the buyers have been waiting for. And after 2 years of volatility, people want predictability more than cheap money. For buyers, this period is the calm before the storm before activity picks up again. And the window between now and the rate cuts fully filter through, that's 12 to 24 months lag, that could offer better selection and less competition. For sellers, pricing is still everything. The market isn't broken, it's just slower. Homes that will show up well will hit the right price point. They're still moving, but it's not 2021 anymore. Buyers have more leverage and more time to think. And for investors, the fundamentals still haven't disappeared. Detached supply remains tight. The single-family completions are the lowest in nearly 30 years, which means that the supply won't be there when the demand comes back. That's a recipe for long-term stability, even if short-term gains are muted. The truth is, we're stuck in a transition period. The worst of the rate shock is behind us, but the full recovery really hasn't fully started yet. If the economy holds up, and that's a big if, immigration levels stabilize, and inflation doesn't flare up again, 2025 could shape up to be a surprisingly balanced market, one where opportunities come from patience and not panic. So are rates in a good place? Yeah, they are, but it's the world around those rates, the policy shifts, the global trade, and the human psychology. That will decide where the real estate market goes next. And the story is still being written.
Add it up.
Thanks for sticking out to the very end. I hope you got some value out of this. Do me a favor, please press like and subscribe, but more than anything, leave me some feedback so we know what to produce for you going forward. Thanks again.